Lovely, lovely, lovely people. How are you? How are you? How are you? Good to be back with you. How is it doing? We are the market sniper, traditional markets. That's right. That's what we are, and that's what we're doing. How are you guys doing? Good to connect again with you. So, a couple of things. What's happening tomorrow? What's happening tomorrow? He says non-farm is happening tomorrow. That's what's happening. And as you probably know, it's meant to be a big data number, and it's been a bit of a damn squid for a while. But in actual fact, there's a chance that we may actually have some action this time. There's a chance that we may have some action sometime on the non-farm. Yes. And why do I say that? The charts are speaking. They are speaking. They speak an interesting language. You have to spend some time to learn that language, actually. And many times you misinterpret it, but they're speaking a little bit. Hey, Venik, how are you? Yes, nice to see you. Thanks. And by the way, liking and sharing is awesome, and we appreciate it. And it gets some action going in the chats for you to talk about and share as well. So what have I got for you? St. Gaulis, good. It's turn apocalypse. Hey, Eddie. Nice to see you. Thanks for checking in. So what have I got for you? Well, non-farm tomorrow, and I think we may get some dollar action. So here's what happened. The Fed chief Satan, who was currently saying previously in October that guys, we're going to normalize interest rates. We're a long way away from neutral interest rates. Neutral interest rates are meant to be that phenomenon when you're balancing economic growth and you're also keeping an eye at containing unnatural exuberance. Yes, so neutral rates, the balancing act. Now, traditionally, this was always perceived as being in and around the 5 and 6%. So that's talking about, 5 or 6%. You've got a right amount of stimulus for the economy, a certain amount of reward for savers who actually make money available, and a certain benchmark that certain investments have to beat to become interesting. Because if I'm investing in your business or scheme, there's a lot of risk involved with that. If I can stick it in a bank, which used to be perceived as risk-free, personally, I don't feel that applies with nearly the same amount of meaning as it once did. But nonetheless, let's put that aside. It was deemed risk-free. I don't need to get a 4% from you if I can get 4% from a bank. So that was, as a saver, you would have to offer me 10, 11 to allow for the fact that there's certain risk in your business failing, maybe 20, 30%. Greetings from Sweden. Mark, I'm glad to have you, buddy. I bet it's dark there as well, because it's pretty dark out here, and we're a bit further south than you. Anyway, so what have we got? So the non-farm is coming, and it's been a bit of a damn squid for most of the time, but this one's a little different. This one's a little different because that same Fed chief Satan said suddenly within 1 month, we're very, very close to being on neutral rates. This is at 2.25%. At 2.25%, suddenly he was, instead of being very, very far with literally barely one quarter point rate change, you're just about there. Now, this was seen correctly by everyone as a major step off the gas. A major step off the gas in terms of the rate rising. And why would that be, you might ask? Well, if you didn't, I'll answer anyway. Because the markets reacted rather badly. We'd made a prediction that the October period was going to be a particularly jumpy period. We'd hit all-time highs in the September, and we said, well, this is now roughly a year from when the interest rate cycle started to come into effect. And now we have a situation where we are now slowing the heck down, and the market threw it down in rather a brutal fashion. In fact, in many areas of business, I think there was quite a sudden little calming. Now, I'm looking for an article here on my device because there's something else that was really, really interesting, and I was discussing it with one of my students, and it was that the inversion of the yield curve. Now, some of you, your eyes might glaze over and you say, what on earth is this bald gentleman in a jacket speaking about, the inversion of the yield curve. So I need to explain this, and I want to get a table up that I had as a resource to talk to you about as I do it. Good, I've got it up and I can carry on. So essentially, governments are issuing debt at an unparalleled level. Yes, you understand that. I understand that. Now, what they tend to do is they have various terms of period for that debt. So you get paid an interest rate for a certain period, and at the end of that period, they give you the money back. So you lend them 30 billion. That wouldn't obviously be one person. All of us pensions lending X, Y, and whatever amounts, and the government commits by contract to borrow that money and to pay every year a fixed rate. And then at the end of however long the term is, 30 years, give that original 30 billion back. So you get the capital back. And what they keep doing is rolling the debt. They never actually pay any of it off, and they issue new debt. So they keep expanding this portfolio, which is why we are in the interest rate environment can't go up. We've added way too much debt. So what typically comes, and Sant Gaulis is all over it, inverted the yield. Yes, the yield has been inverted, and within a certain period, it's been one of the most best indicators. So what tends to happen is most people don't like having short-term money. So too many people start buying the long-term. They buy the long-term debt because they don't like owning too much of the short-term debt because it's riskier. And what tends to happen then is too much demand for the very long-term debt and not enough for the 3-month and the 5-year debt means that instead of the yield going consistently up as the term goes up, so a 30-year you get paid a longer amount because there's more inflation and everything likely in it, people start crowding on the long-term end and they buy too much of it. Now, when you buy a bond, lots of people are chasing it, you push the value of it up, and therefore the return on it goes down. The percentage return on it goes down. There's an inverse relationship. So if lots of people are buying the long end and very few people wanting the short end has to offer a higher rate of return to attract people to it because there's insufficient demand and its value is reducing. So the higher interest rate, the more its value has reduced. There's that inverse relationship. And that's what causes the yield curve to invert. You start having lower interest rates for long-term debt and higher interest rates for the here and now. People are very worried about the short term, the next year or two, and they feel they're okay with being governments aren't supposed to go bust. They're okay with rather having parked it up in long-term debt. So it is going to be a tough old time when you get yield inversion, and it's typically a very reliable indicator for recessions. So we've said the first interest rate turn in the cycle was a year ago when we came to October, 34 months actually. Sorry, well, I'm not correct. The yield curve inverted more than a year ago. And the other indicator, I said the 34 months from the first change in the interest rate cycle when they started tightening the US was 34 months ago in October. And that is the average time, just under 3 years. So just under 3 years from the first move to the upside of the rate, 34 months, is the average when you have a recession. So just under 3 years into a new rate rising cycle, you have a recession. So that's one indicator. And now we're over a year into the inversion of the yield curve for a recession. So as we've been saying it, we're wanting everyone to be bear. Great day for shorters, says Horam, and he's spot on. Great student of ours, by the way. Good posting in Sniper Circle, bud. And we've got some real concern about the future for asset prices in all areas. A recession is not good. And when you consider how over indebted we are and the state and nature of the game, what's actually going to happen is we don't have normal mild recessions anymore. We've got more extreme. It's kind of like a volatility curve where the violence just gets more. You're getting the initial warning shocks of the earthquake, and then they start doing this, and then it's this, and then it's that. And that's kind of how it gets. The deeper in you get into this, the more whiplash you get. So We already have the Bitcoin recession. We had the Bitcoin boom and the recession. Bitcoin's on a totally different time frame, and it's blown out. And now we've got other assets that have done, to a degree, the same amount of hyperbolicness that has gone on. So I'm going to refer to my little app device, and I'm going to show you. I'm going to mention the stats because this is quite useful and interesting. This is not something I'm making up. I'm reporting to you as the market sniper, wearing the market sniper hat today. It's a little bit invisible today, but nonetheless, it doesn't hide my hairstyle any. So the date of first inversion, typically, so here's a couple of examples. 29th of September 1965, date of bull market top, September 66, 1 year. And then subsequent, 67, June 67, date of top, March 68. That was 9 months. 73, August 73 was the first inversion of the curve. Bear in mind they say first because it can sometimes bounce back a little bit and then it can bounce around and then but it starts happening for the first time. So August 73, and they actually toppled in November 73. So that one came pretty brutal. That was the high. That was the final high of the market. So 3 months later, you made the high. So you've had 3 months, 9 months, and a year. Let's get into the more recent ones. 1980, that was in December. And my apologies, that was in, this is American dates. It confuses the hell into me. That was September. So it was 9. And by April of 81, the next year, so roughly 6 months, you had your high in for your equity markets. 89, some of you might have been alive by then. My lovely sniper kidlets. January 89, and the top of the market was July 1990. So think about that. January 89, July 90. That was actually a full 18 months. So that was quite a long one from when you had your very first inversion of the yield curve to when you toppled over. So then we get to September 98. Now I'm betting at least 50% of you were born by then. You aren't all as aged as my good self. So September 98, and that ended up flicking on January 2000. January 2000. So do the maths there. 3 months to 99 and all of 99. So this is more recent history. I remember that 98 crash and it went with the Asian crisis and many others. And that's, you're talking about just over a year and a bit there, a year and 3 months. So when was the final one? 12 December, that's December 05. The first inversion. So this brings us up to date with the crash of all crashes that you will all probably remember quite well. December 05 was your first warning yield curve. So you went into 06, all of 2006, and you'd already tipped on your yield curve once. December, yes. You've tipped on your yield curve in December of 05. So all of 2006. When did we bomb? The high was in the 10th month. That's October of 07. So that's October of 07. So essentially all of 06, that's 12. And you took 10 months out of the following year. So what's happened is it appears to me that generally we've lengthened a little bit from when we get the first inversion because they're fiddling. The Fed is tweaking, QEing, mucking around with the rates. They're trying to extend and save us from pain. The no pain economy. And so they keep pumping hopium into the system that little bit longer. So it might take, let's say, 2 years at the maximum. 2 years at the maximum. We're well past. Now I'd like to know, and I'll have to consort, when was the actual very, very first moment that the yield curve tipped since that recession. But I know already that we are, let's just get to this, see if I can see it. We are already well past a year into that. In fact, the lead time between yield curve inversions and final bull markets peaks was closer to 18 months. This highlights a potentially major risk. I'm reading to you now, but I want to get this right. It's quite important. A real major risk to investors, the risk of being too early if you want to short. So indices are a sod to get right for shorting, guys. And many people will short too soon. The minute the yield curve inverts, they'll short. That's often when you get the final blow-off moments, or you have a sustained trend and you still get a subsequent blow-off. People will do it too soon. We don't want to be too soon, but we want to be on a watching remit to implement our shorting strategies from now onwards with all indices. And I would say your best pick are the US indices, which are the highest of them all by all measures of valuation. By all measures of valuation, the inversion curve is really, really high. For my guys, I'm going to repeat this and go into more detail on the non-farm payroll. We'll talk about it tomorrow. And for those of you that are not part of our community or anything, I'm doing a guest visit ticket. You can buy a ticket to come on to non-farm payroll, by the way. And you will get two. You'll get our FX, equities, and indices, which are general markets, where we're going to be looking at a lot of interesting things. Been talking to the community about the USDJPY just now, and many others, and other FX that we really, really like. There's another one that I'll tell you about if you're on non-farm. There's actually a few, and we'll also check into those indices. Then we'll have a half-hour lunch, and then we'll go into a crypto retake. I've been quiet and keeping to myself on that because we're in progress decay. We'll see what develops between now and the morning tomorrow. We've had Bitcoin do a wee little tip through that absolute low on the target. Is it going to bleed out to the downside? We'll soon see. We'll check in with that. So you can be part of that. 2 1.5 hour sessions with a little half-hour lunch and pee break in between for your comfort. But anyway, back to this. So we are deep in the warning period. The robot has already gone off green, turned onto yellow, and are as a number of seconds already into yellow light. What comes next is the red light, and it could be a fraction of a second away or a number of seconds away, which could still mean months in this analogy that I'm using. But believe you me, this is one of the strongest, most powerful indicators for major tops being in on the equity markets. And just to recap, the last top that most of you can all go look on your charts and see, which will be meaningful for all of you because it was recent history, is the October of 2007. Think how you might have done. And I can't do screen share, but I'll be doing this all on non-farm payroll and with my premium community and any guests that choose to attend. Think how you might have done had you shorted in October 2007. And held and held. And believe you me, once those start to move in your favor, it's the easiest trade in the world. You step back and you watch Rome burn. If you've got some petrol, feel free to chuck a bit on, throw the can in as well. But you don't need to do anything. You just need to sit. The money's made in these instances, and in most instances, actually, in the sitting, not in the trading. Getting on at the right place, at the right time, and then stand the hell back and let Rome burn. And the US indices will be the pick of the bunch for the big, big short. Friday Crypto Finds. What is Friday Crypto Finds? So we look specifically at the crypto market. We look to see if there's anything tradable. We look at our God markets, which is Bitcoin. That's where, as I've said before, when I did the crypto live screen, you should be spending the bulk of your time in there. Pop on and have a look. We'll look to see where we think it's going. We'll play out various scenarios. If it does this, then that, and we will apply a futurist mindset in what the price behavior gives us. If it does this, then these are the 3 scenarios that will play out, and we will be able to detect it early, and we'll have a template for what we want to do next. Do I think there's an actual live trade that I will take in Crypto Finds? No, because we're in between. We're in between a major performing pattern. But is that laying down? This is where you do your best work in terms of the scenario casting, as we call it, for your cryptos. It will indeed be. We'll also look at relative strength for when they do bottom, which ones should you be in? And we'll look at all major liquid coins for that. So that's what's going to be in Friday Crypto Finds. Robot equals traffic light. Yes, default. Thank you. I'm being a South African and using South Africanisms. Traffic lights. We're very basic people. We used to call them robots. It's like it's this clever thing. No, it's a traffic light. Thank you for that, default. I appreciate it. Yeah, those phrases die hard. Why did the central bankers not prevent the yield curve from inverting? Okay, so that's an interesting question from Scandal. And this is it. They don't and can't control absolutely everything. And in fact, they might even be part and parcel of the reason that it inverts. So short-term high risk debt becomes unattractive. In short, it's supply and demand. You have lots of smart people in the institutions that say, we're getting deep into extra time. I think I'll rather have more long-term bonds, thank you. And they start buying them. And then you start seeing people do it. Just like you get smart institutional money that takes money off as it starts approaching the top and having done too much. And we've got to, as traders, be the smart money, not be the chase the pump money. That's the FOMO. That's the I don't care what price, I just have to be in money. That's the Bitcoin at $18,000 and moving $4,000 or $5,000 a week in the last 2-3 weeks. That's that entry versus the guy saying, I want to be selling into that. And we need to be the smart money about this. So we've got to understand what's coming. We have to look forward and scenario for that and not be long. So the trade, once again, is bear or square, as I call it, bear or square. That means square now looking for a bear. Yeah. So you're out in the forest and you're flat and you got your rifle and you're hunting a bear. You're not looking for bulls. You're not in the farmyard. You're staying well clear of that. Beef's not on the menu. Bear's on the menu. Yeah. Straits wicked to zero on Binance. Stratus to zero on Binance, says Declan. May well be. I think, let's be clear. I think if this turns ugly on the traditional markets, it won't be over for the crypto markets. Why saith he that? We'll discuss in more detail on non-farm as well, because we'll have plenty of time. But when you get a deflationary fear in my environment, what's actually going to go up is that long-term debt. Believe it or not, there's way too much debt around, but the Pavlovian institutional responses are that governments will just pass the buck on future generations and that the long-term debt will always be paid. So people will park up for safety. It's no longer about making money. It's about protecting what you have. The dollar will go up because it's the biggest government in the world. So other countries will buy American long-term debt as well as Americans. And that's exactly what they need because they're creating too much of it. They need a bit of demand. They need a bit of fear. But that'll mean people rotate out of equities and equities can throw it down. So put options, buying them, and eventually selling calls if you know about options. But once again, you still have to get your timing right and you need sufficient time in your option to manifest some of those rewards. So we have a method and a strategy and we'll be applying it and we'll look at that on the non-farm payroll. If you've thought, hey, some of what you say sounds interesting, but you're asking a lot of money and you want to come and see what we're all about, you can meet some of our premium guys in the go-to meeting and you can jump on for under £200. You can have both non-farms in and come and spend the better part of 3 hours with us with a half-hour lunch break, 3.5 hours, chatting with the guys in lunchtime. I'll leave it open. And they'll tell you exactly what they think. And you can also be part of the crypto search and the FX equities and indices. So what else are guys asking? AST, complete working decentralized P2P exchange, total market cap of $4 million, insanely oversold. Maybe. I think more alts will go bust. If there's alts which are highly liquid, you think they might be oversold, many things can become even further oversold. So the point I was making is if we go into a fear environment, everyone gets into comfort. They want cash on them in their wallets. They want money in the bank and they don't want high risk investments. And the problem with crypto is they deemed a volatile market. When you just don't want to lose, the last thing you want is volatility. Underlying market that's volatile. So people get out, they get out of the high volatility instruments and into the safe, inverted commas, havens, which amazingly is the dollar and is even government debt, amazingly on both fronts. I'm neither a fan of either. I'd prefer to have the notes under my control, under the boards, on the floor, and a truckload of gold and silver, but you will find gold and silver's price will deflate too, which is why I've continued to be a bear on gold and silver, even though I value their uniqueness of property and fundamentally sympathetic gold bug. But it's timing. Entries matter. Entries absolutely matter. Many people forget when we first had a deflation, gold had gone up to $1,003. Just put a toe through it. It traded all the way down in the dot-com smash to 668. You could have bought it at 668, and then next thing you knew, we had that was our amplitude that gave us a $400 that got us to a chance to project 1,300 gold to the upside later, only for it to overperform. What else are you guys asking? Louis Velasquez, Francis, could you please take a look in Mexican USD chart? I think peso is approaching a devaluation. Thank you in advance. Louis, yeah, thanks for your question. We actually spend a lot of time looking at the emergings. We've done exceedingly well with USD-TRY, both to the long side, guys, and then back down. We've been a buyer of TRY and being paid 16%. We've had positive carry and made P&L on that when everyone else is going, oh, it's only going to go to the moon. So you will see all about that. Platinum, as I mentioned on precious metals, there will be specific uniquenesses about the individual metals, but you've got to get the big macro God elements right. I call it God elements. If you can plan the greatest picnic in the world, but if God decides it's a lightning storm, a thunderstorm, and more rain to fall in the next hour than he's ever thrown down on the planet ever before, your picnic is stuffed. Doesn't matter even if you plan tents, the wind will whip them up and turn them into whatever. There's certain things that are above the extraordinary elements that you control. You need to recognize who's shaking this tree. And when we look at the God elements, if we go into the deflation, if we have a top that's put in, that's going to be a serial marker top that will mean during the next period, it will be part and parcel of making downside DNA. In fact, the top could already have been in this September because we've already had 34 months since the first interest rate. We don't know when we get that inverted structure. Boy, it's time. So I'll tell you, I'm regularly wrong on calling shorts on indices, and I could be wrong again, but now, as we're getting into the extra time period, I'm going to be more aggressive to look for those shorts. But I can and will be wrong. But we'll talk about that and how we'll do it. Other guys are asking about zinc. I don't have a specific view on zinc. It's an industrial metal. It will be treated, I suspect, overall like copper and many of the others. Copper had huge inverted HVFs, huge sell-offs, and we could see that China was balking and dying of debt before the news even hit. And our targets were made on mega calls on copper. And they were the guys that were buying and building ghost cities on a huge scale that are still in existence today. And they were being the buyer of last resort. And then we had the commodity crash with the China's debt detox. And then suddenly Australia started slowing down. Finally, they realized house prices don't only go up. And I'm not wishing it on my Aussie friends, especially if they own property, but I'm just calling it like it is. So let's see, Ethereum still too high. Ethereum will go into double digits, in my opinion, and possibly even further deep into that. Why did the central bankers, what have we got here? Matja Feist, have we talked about crypto today? We will talk about it tomorrow if you care to attend. Matja, we'd be delighted to have you, and you will get an hour and a half of nothing but crypto. How much time are we going to have? Are we going to have a bear market? So I don't know the date. I couldn't say to you, well, it'll be Wednesday, the 23rd of. I can't answer it like that, Yanai. But what I can tell you is that we're in injury time. Injury time, that still means it could be up to a year. It could be a month away. I would say that's it for the next recession. We're going to be in there, and I'm not on the year side. I think 2 months, 3 months, you could have a very ugly first quarter. And I also suspect that Santa Claus is not going to be visiting the retailers so big this year. And watch for the headlines in the news about bad Christmas retail. And what else? Thank Tar for being a good role model for the trading community. Pleasure, Matja Feist. I appreciate you for that. I'll keep working at it and keep honest and straight. Declan, a lot of air left in XRP to come. XRP's, it's not deflated. It's had relative strength. And, we had EOS that was actually going strong. And everyone said, the rest of the crypto market's dying. But now there's EOS. It's the moon. eventually these things come back to gravity. And no, I'm not trying to bring that topic up just to rub the EOS guy's face in it again. The notion is the asset category dies. You can only be a winner for so long. If I grease all the poles, you can be the greatest athlete, but after you've done climbing and you keep sliding back down, doesn't matter how hard you try. You're in a greased pole environment. You're slipping all the way down and you're going to be sat on your ass at the bottom of the goddamn pole. Doesn't matter the extent of athlete you be. I've oiled them poles and I'm setting the circumstance, and I'm the god of the greased pole market. How's that? Oh, tell your girlfriend you were chatting with a guy who is the god of the greased pole market. Oh, I don't know what they're going to say. But anyway, so that's the point. It doesn't matter how good a climber you are in that environment. You might get a scurry for a while, but you won't beat the inevitable. We can't swim upstream. You won't swim upstream the Amazon to source from the ocean. You swim with the current, not against it. And what else have we got there? There is a link, very kindly. One of my guys is sharing it, Non Farm. If you want to have a look at it, come on board. And as I say, it's a small chance of having a sample of time with us and the rest of the guys as well, who are equally important. I love the community. We've got good guys. We've got more good things coming for them, and I'll be updating them on that. Mark Hauschild, greetings from Sweden. I've read that one already. I hope Sweden's still with us. Would you buy silver bullion coins yet? You're expecting sub 14 thing. So I'll repeat again. These are many different ways of asking the same question, guys, and the answer remains the same. You may have missed it, so I'm in no way dissing you. I'm just wanting to answer it for clarity for all things bullion and the deflation environment. This is what happens when you have a major top come in on the equity market, which we've been speaking about with the inverted curve. If it comes in and that is a top, the reason it's a top is because you later go into some recession and highly corrective environment for the equity in markets. And if that occurs, you get contraction, lack of spending, fear. That's in most people. It starts in the bankers and the city people. You might not even have much exposure to equities. The problem is if the banks start laying off people, the investment funds start laying off people, hedge funds start going bust, banks lose money because they've given too much corporate debt to XY hedge fund, XY investment company, XY this. Everybody starts retrenching and there's a knock-on domino effect. And the financial market is like this big Trojan tick. It's so fat under the belly of this cow, it's now this big. The problem is it's disproportionately large for this. It's not a producer's thing, it's a financialization of everything thing. We have subprime student loans, we have subprime cars, we have subprime. Everything gets financialized if we go into fear and nobody can borrow and banks are in trouble and are contracting and this is a liquidity off. Everything deflates, including the good things. Why? Because people sell all their shit to get into cash, including the good investments. And sometimes they say, oh, but I don't want to sell this. This is a good investment. And they get forced sellers. Most of the smart guys in the city probably knew that 2009 was a low for buying stocks they don't want to sell. But you know what? When 4 or 5 of the guys in the nearby desks have all been fired and you're having your liquidity lines pulled and your fund manager taps you on the back and says, trader, you can't hold those positions anymore. You're not making money. You need to wind them up. And you say, no, but they're at the bottom. They're going to come good. No, sorry, we've been told to reduce our exposure. You become a forced closure at the lows. And even if you know it in your system, but the entire system around you is failing, you can't be strong. I can't hold up this building. If all the pillars around are going down, I'm getting crushed, no matter how vigilant I am. And that's what happens. Forced selling. Even institution that is normally smart and holds through and buys the damn dip in the bull markets off the retail fools, they become forced sellers as well. Any thoughts on platinum, palladium if you haven't spoken on it already? So once again, all in the precious, semi-precious to quasi-industrial precious, because palladium used in catalytic converters, etc., etc. I'm not going to give you a specific comment on that. Those on non-farm, I will look at the relative strengths across the metals as a moot point. But I would say don't be buying any PMs now. Build cash for reset and fear. Buy at the bottom when everybody is absolutely depressed. That will be your lows for gold, because the solution will be QE, and then you'll get the metals moving again. Problem, action, solution. Still got time to buy. It's got room to drop. That's it. Original copy. You've nailed it, buddy. Johnny OC. Warren Buffett has gone seriously towards cash too. Yes, he has. Thank you for explaining that crush. Sell everything scenario. Yes, he has. Pleasure for help. I'm glad you cottoned on, Johnny. He has too. And in fact, Rich Dad, Poor Dad, Robert Kiyosaki, smart man too, more everyday guy than Buffett, but Buffett is a very good benchmark, although I consider him a part of the control structure now. But if we just have a talk about Kiyosaki, Kiyosaki is a never sell my property guy, just build and accumulate portfolio. He's actually admitted that people had been coming and offering such silly money for his buildings with their yields and paying way over the odds. He started to let them go. He's actually built cash and is selling property. This is a man who built his wealth by owning rental apartment blocks with management companies looking after tenants in blue collar areas, middle income areas, everything. This big ass landlord across the states. And he's saying, okay, take it. If you're going to pay that, there comes a point where I say no. And I will remind those that are of UK bias, and for the international crowd, you'll understand this. The HSBC building in Canary Wharf in London that sits on the Thames, at the peak just before the subprime crisis, sold its entire building with how it was let at the time, with the rents on that building as a landmark building paying less than 1%. The people who bought it paid so much that they were actually getting 9-point-something% yield. 9-point-something% yield. It was billions they paid. So they were paying for a future rental flow that wasn't even giving them 1% per annum yield on their investment. That is a sign of the top. You want a banner building, you're going to pay stupid money? Okay, I've just got to let it go. I'll buy it back for you for 6% yield for a fifth of the price you paid. When the bankers come and call your loan in because you're not servicing your debt and everybody's not spending, and a lot of people are retiring their office space, so you're not even getting 0.9% yield, you're getting 0.6%, and you can't make your payment because you bought the top of the goddamn market because you wanted to be a hero that owned one of the tallest towers of 3 towers in the Canary Wharf. Good luck. That's ego. It's not smarts. Price matters. Entry point matters. That's the situation with commercial property. That's the situation with residential property. In the same way Buffett is building cash and divesting, you get other asset categories such as property being divested because people are doing the idiot buy thing. I have to have apartment blocks. I need to be this big deal. It's not the time. Lease back. Yep, says somebody. Hi, Phil, Horim, Divolt, nice to see you. Yep, that's hi, I asked you a while ago on a comment, but you probably missed it. Do you think it's worth buying a property overseas? So I'm hoping what I've just said around property, Jason, gives you the context. Property, every asset class. Let me just say this. Any bullion that you elect, any quasi semi-precious stroke industrial, palladium and platinum, which are very precious and industrial, any industrial purely, copper, zinc, any property, commercial or residential, whether it be Malta, Cyprus, Nice, beautiful, south of France, central Paris, New York apartments. Do not do it now. That is my take. Do not do it now. Buy at the bottom lows of the recession when everyone thinks it's going on forever and the banks have all called everyone in. Build cash now. Don't spend on Christmas. The January sales are going to be freaking awesome. Buy what you want for a third of the price after the retailers are closing shops. Hear me now. Defund the extractors and their peak consumption, get 65% of their revenue in those 2 months. Stuff them. This holiday mayhem of consumption where you feel emotionally obliged. Tell all your kids and your wives, your presents arrive mid-January. Buy something small in a little jewelry box, a colored stone, a piece of art, do something cranky and have fun and put that under the tree and get the real gifts out in the mid-January. for a third of the price. Trouser the difference into your cash pot. Go into this recession cash strong when everyone else is going in indebted. Do not spend on credit. Kill your debt. Do yourself a favor. Be strong. Be strong now so that you can pick up the bargains when the blood is running in the street. Pest Master Bizzle, when can you foresee the worst point of the recession? There will be indicators. It will be absolutely horrible headlines. Horrible headlines are usually your best indicator. And of course, extreme lows that you never thought you would see on share equities, all sorts of things. Sales everywhere, shops closing down, retailers being murdered, every second one in trouble, bankruptcies hitting all highs. You want an indicator. Let me give you an indicator. Pez Master Bizzle, when can you foresee the worst point of the recession? Timescale. Can't give you timescale. I'm going to give you an indicator. Thank you for your question. Here's your indicator. Track the rate of bankruptcies of individuals when they are hitting all-time highs, and they're starting, because there's a bit of a delay. People fight it. They fight it for a while. That means by the time you're hitting the all-time highs, you're probably already bottomed out because there's a lag. There's a natural lag. Track bankruptcies. You can do it on corporates as well. Liquidations and closing of companies. Track it. That's how they're going to tip the table and get all the chips down the central banker's end and own all the wealth. This is how they're going to shake you out. How to get rich in 5 minutes. Hard techno shranzy. I'm not sure he's referring to what I'm saying. DL, hi Francis, would you suggest adding silver now? No. Pez Master Bizzle, thank you, sir. Pleasure, mate. What else have we got here? Is it possible to make a 70% return with swing trading a year? To me, it seems possible. I've seen it working in 2000 a year, and it's been a year for swing trade. It's possible to make that and more. It's possible to build wealth on even half that a year. You just have to be able to grow your pot. If you can do 30%, you guys will come on board. Those that elect to, we've got a self-study program. If you elect to come on board, you'll get every Sunday with Brett, who's in Australia, Melbourne, young man, ex-tattoo artist, owns a Harley, cool dude, everyday guy, younger than most of you on here. And he's over 40% for the year to date. And he doesn't touch his pot. He keeps growing it. It's the goose that's laying eggs. You can probably do more. Let me tell you, he's achieved that with doing under 2% drawdown. He's never risking more than 2% on his trade. That is what Brett has achieved, never risking 2% of his trade. He was here in my property here. We're trading. I'm more interested in what my students are doing. I don't talk personally about what I do. People hate gurus. I'm not a guru. Find out what other people are doing with what we got and can do. Does everybody do that? No. Some of the guys don't know and aren't ready to take on a method. It's a journey. Brett battled for a year first. But he kept showing up and he kept learning, and then it clicked for him, and he's not looked back. And you can ask him for yourself. He will be on Non Farm tomorrow. And if you come on board, you will do webinars with him. It's one of my top guns. He was where a lot of you guys were 18 months ago. That's it. Not that long ago. Okay. What else? Final questions before I run. Would you suggest buying REITs at all-time low? I would wait. V Speaks, thank you, by the way. You always conduct yourself like a gent in the comments. I respect you. Would you suggest buying a REIT at all-time low? I don't know if you mean by that the REITs are now at an all-time low, or whether I would, when the low comes post correction, buy a REIT. I think any investment in hard property that has a real yield has long-term value. So anything that produces a stream of income, there's the standard weighted average cost of capital calculation that tells you what it should be, given the certain risk-free rates and all of that. And they will drop to ridiculously low. That's when all the government-approved hedge funds, all the government employees, the Tony Blairs of this world that are now suddenly traders and have Bloomberg screens and have never done a sodding thing of a financial nature in their entire life, apart from being rapists in Iraq, war liars. That's where these guys, pick up property, and next thing you know, your friendly blue-collar guy who's been shaken out of his home, all these properties in that area bundled up and now owned by a hedge fund and being landlorded out. That's what I see happening. What else have we got? Thank you, sir. Yes, pleasure. Have you heard about Nex? No, I don't. I don't know too much about it. Commercial banks have a huge JPY net position. So Raul Chahal is sharing some of his wisdom and insight here. Commercial banks have a huge JPY net position, he says, something major in terms of potential downtrend later. Yes, it could be. It could indeed be. I would expect the Jap banks particularly so. His BTC chart looks like silver chart to a degree. I think it can bleed out more like the metals is the short answer, Daniel. But time will tell. We'll see if it's continuation. I think it traded a little lower than the spike that took us out our target today. So that could also be bottoming, but it will be slow bottoming. Gabby's FX School, trading with patience. General Sniper, what's your thoughts on ADA? So overall, cryptos is still a bear market, and there's contraction in the air for now. Off the top of my head view, not specific to ADA. I will look at. We traded ADA on the long side. I've not actually shorted it. I don't think I jumped on the other coins. We'll have a look at it if there's enough interest in crypto finds tomorrow. So pop on if you'd like. Many thanks for sharing your knowledge. That's an absolute pleasure, Flix. You're a gentleman or a gentle lady, whichever gender you are. And so come over to our trading day. As I've said, you'll get both a crypto view if you're a crypto kid, and you'll also get the general market. Now, let me just say, if you're a crypto kid and you come into cryptos via the fact that it's tech, it's exciting, it's new money, you're libertarian, that's all good with me. I'm all those things. But what you'll learn is that actually all asset categories are affected by the market cycle. And when there's fear and things get sold, they're sold. You'll actually learn to find value in the Forex sections. You might say, I only want to see the one half of this. In actual fact, you get a lot of value out of realizing the market cycle. Let's talk about yield curves, overextension of a bull market, injury time, possible sell-off. Timing when you buy makes so much difference. It makes so much difference. You know, if you miss the 5 or 6 worst days a year in the equity market, it almost doubles and in certain instances triples your return. Just think about that. If you could take out the 5 or 6 worst days in every equity year, and in certain banner years like 1987, I mean, it's actually ridiculous. If you could be out of the market and back in at the bottom for those 6 days, I mean, the change it brings. Now, obviously, that is a fantasy, but you can make sure you miss the overall bad legs. So remember this, guys. Trading day tomorrow. This is what this YouTube is about. Give you a bit of wisdom, share a little bit about what we are. Come and get some more time if it suits and if you feel connected or that it's of interest. If it's not something that works for you and you get a little bit of an idea, but that's it. It's also cool by me. YouTube is free. Just play nice in the comments, respect everyone else in the comments, and I'm good with that. So let's just see. I am a Prime member since March. I'm still learning every day, but I'm in profits. Francis is not a guru. He is the real deal. That's very kind, Andy. I appreciate you to come on and say positive things. He has a method that works. And that method, if I may, is totally transferable to every single one of you. And Andy is an example of it. He put the effort in. He's getting what he deserves. I get a kick out of other people that trusted me, invested with me, gave me of their energy, because your money is energy. It's your salt of your back, the sweat of your back and earned, and then you start to get something back for that. Well done for investing, Andy, and well done for making it work. You still have to show up, you still have to do the basics, and you've done that. Good on you, mate. Yana Mass, thanks for answering. Will the banks allow taking out money from the account in the crash? A lot of people are talking about everybody having money on digital screen only. Good point, Yana Mass. So here's the thing. Be heavy cash, as in cash, notes cash. Put it somewhere safe. Don't leave it all in the bank. So we've had microcosms of events in big resets. If this is an ugly one, which I do still think we have outlier chance of it being the ugly ones of the ugly category, they will restrict how much cash you can draw out the bank. Banks don't want to have a run. They're just going to stop you. By the time you realize that, it's too late. You've got the queue outside Northern Rock. If you think this doesn't happen and it's Armageddonist, just look at a UK. Go see Northern Rock. That was a bank that most of Newcastle and large swathes of Northern England and even in Southern England had bank accounts, and you saw queues of people around the door, and you didn't get your money. Do you want to be caught in that situation? By the time you're acting with the 91% and joining the back of a queue, you've already lost, guys. You've already lost. The preparation is before, not once it's clear and everybody knows. That's when the stampede is on. Then you're just a cow in the middle of a stampede. You go where the stampede goes. You can't even turn right. There is no turning right. There's 5,000 blindsided bulls charging, and you just have to not get trampled by them. It's too late. You need to be the guy that goes in the night all by yourself early, ahead of schedule, ahead of the event, and gets the preview on the movie, sitting with your popcorn, the only guy in the cinema, in the big fat seat with the big fat slush puppy, and you get to see the whole flipping show early. That's what it's all about. Don't be caught in the stampede that run in. That's for the retail monkeys. I'm here to help everyone to stop being the 91% retail monkey. Non-farm tomorrow and trading day, you can get a little bit more of an insight of what we'll do on crypto sniper side and on the market sniper side. And this is important, and they overlap. I mean, no one cares about other people's logos, but if you look at our logo, it's 3 circles and they overlap. It's the reset sniper, the fact that we've got this big ass dump to take, and you need to prepare for this. I'm messianic about this. This is why I keep showing up. You need to prepare for that. Crypto will have a role in that, and it's one of the other circles that overlaps the reset one, and there's an area. And method and the market sniper techniques is how you ensure you get the best out of it. You want to be market sniper in the middle of that spot that all 3 overlap, because you need to understand all 3. You can say, I'm a crypto guy, and I say to you, understand everything. You need to be global macro. You need to understand if the market takes a dump, it doesn't mean if you've got the best coin in the freaking world, it can lose 66%. I'm hoping by now I've proved that. I've called it before it happened, and it's gone and happened. Not to be a hero, not to be a guru, to implement a method. I want you to understand you need that method to have been able to do that. It's not me, it's the system, it's the process that puts you in a position to do that. You need to prep and understand this is unheralded economic times. That's the reset sniper. How do you prepare for that? Have your cash notes, have way more. Store them in your mom's house, put it under your floorboards. I don't know where you live. I'm not going to come steal it. You don't know where I live. You don't know how creative I am. You're safe. How many times has your house been broken into this year or the last 5 years? It's safer there than it's going to be in that goddamn bank, because banks take away what you need when you most need it. And they're there offering you what you don't need when you don't need it. That's their game. Don't trust them. They don't work for you. They work for them. That's the game. Okay. Thank you so much. Majid, thank you for your very kind comment. Real trader, I follow your instruction. I believe in you. Stay blessed and live long. Same to you. Kind words, blessing to you. Come to trading day if it suits. If it doesn't, it's cool. I'm glad. Either way, we look forward to seeing you. Non-farm payrolls, I think it's going to be more significant. That's why I do it. I don't do this every first Friday of every month. I've been disappointed by what's been coming out of non-farm. But this time, we're getting a number on the power of the economic situation in America. The most important statistic: how many jobs have they created? This is whether you're growing or whether you're dying. And that number is going to be important. They took the brakes on the interest rates. Do they know something about the number that's coming tomorrow? I am asking you. Find out with me. Find out with me. Interpret it and watch the market smash live. I think it can happen. It's a big non-farm. I don't do this first Friday every Friday. And I've opened it up to people who can't afford it typically to do big ass programs and premium communities and all of that. You can attend just for that. That's what I've done. Seize it or leave it. It's all good with me. I can help those that want to be helped. That's my final message. Blessings to you all. Watch out for that data, whether you can make it or not. It could be significant. Bye now, guys. And with that, I speak to you another time. And thanks for attending to all of you that showed up. Bye. And if you retweet and share the link, I love you that little bit more. Bye for now.